Hi there, my name is Michel Girardin. I'm a professor of finance at the University of Geneva and a board member of Novastone's Capital Investment Advisory Board. Since summer last year, we meet on a quarterly basis, and together with my colleagues Christian Malek and Riccardo Cataguiri, we have a look at the global macroeconomic picture and derive some conclusions in terms of investment policy. So the idea of this short video is to give you a brief summary of what we just discussed and what we will do for 2016 in terms of the investment portfolios. So starting with the US, this is one big question that people have, investors have for 2016. Some people see the US economy entering a recession and argue that the Federal Reserve has embarked on a cycle of tightenings which may come too late. We don't see a recession in the US, and as an indicator for that, I show you here this chart which depicts in red the consumer spending, and you see that it's alive and kicking, and in blue you see here this line which is consumer confidence. And what I have identified here is that you have to look at consumer confidence not in level terms, but in changes respective to the previous year. And as long as this line remains above -20, i.e. as long as consumer confidence does not drop by more than 20%, we don't have a risk of a recession. This indicator has been perfect because in all of the recessions which you see here depicted on these purple lines, every time, except for one, the 1982 recession, but every time else when we've had a recession, this line has been dropping hitting this threshold of -20%. May go even below that, and once it recovers and it hits again this threshold, the recession is over. But we're not there. Recession is not a major risk for 2016. The main argument for this is that consumer confidence is driven by employment, and employment is very good in the US. The unemployment rate at 5% is at its so-called NAIRU, the non-accelerating inflation rate of unemployment, so it's full employment basically. And the other argument that we can put forward to justify our optimism on the US economy is that we haven't seen yet the positive impact on the consumption of the drop in oil prices. We've had the first impact, which is negative on CapEx, on investment in capital expenditures, but we haven't had yet the positive impact on consumption. Moving now to the Eurozone, this is another area where we're quite positive on growth. And the reason being that we have a European Central Bank which is conducting a very aggressive monetary policy. In fact, this indicator we have here that puts in relation the 60 billion euros that the European Central Bank is buying in terms of bonds, a way for the central bank to increase liquidity in the system. This 60 billion euros it's buying every month is actually represent 2.5 times the size of net bonds issued in the Eurozone every year. So this is very aggressive. It's actually 5 times more aggressive than what the Federal Reserve was doing when it was conducting an equivalent program of quantitative easing back in 2014. And on top of that, we have Mario Draghi, the president of the European Central Bank, which has given clear indication that the central bank will do whatever it takes to put growth back on track in the Eurozone. Another area where we are pretty confident also on the growth outlook, and we see that finally Abenomics, it looks like it's working, it's Japan. And to assess that, we look at this indicator, which is the jobs to applicant ratio, which you see here on this blue line. And you see in red the evolution of the Nikkei. And you see that the two lines have a good correlation. And you have the bars also, which depict the recessions in Japan. So we clearly have now a good employment, a good job market. We have positive growth in real wages, which is also a very important conditions for the Japanese economy because it relies a lot on consumption. And so this is another market that we like because of the better growth prospects. Now, clearly, last but not least, we have to talk about China. This is also, with the US, a major question mark that people ask about the 2016. Will the landing that we see in Chinese growth now be soft or hard? We are in the camp of the positive optimists. We believe that the landing will be soft. Many reasons for this. We see that there are still a lot of ammunition in terms of monetary policy, in terms of fiscal policy, in terms of currency policy for the country to make sure that the landing of the economy will be soft. The slowdown will not generate a recession. What is happening in China is perfectly normal. We have here an economy which is in transition. It's moving away from investment and export driven to a country which relies more on consumption and services. You can see this from this chart here. Everything which is connecting to manufacturing and investment is slowing down in China. But all the parts which are depicting the picture in terms of services, activity in services and consumption are doing fine. So slowdown here, yes, a bit like the US economy, but no recession risk. Again, here we believe that the country has a lot of ammunitions to promote growth if need be. So all in all, what we see is a pretty favorable environment for so-called risky assets for equity markets. They should continue benefiting from this Goldilocks scenario. You remember this little blonde girl, she gets lost in the woods and she enters this house and there's a little 3 balls and she tastes the big ball and it's way too hot, and then the medium one is way too cold, and then the baby one is not too hot, not too cold, just the right temperature. So Goldilocks scenario for equity market, that's their ideal environment, an economy which is growing, but not too much, because that generates inflationary pressures, which then trigger higher interest rates from the central banks, and equity markets don't like that. Nor an economy which is too cold, i.e. not enough growth, so no corporate earnings, and equity markets don't like that either. So you need growth, but not too much. And that's the kind of environment, inflation-less growth, that's the kind of environment we're in now, and that equity markets should keep on benefiting, especially if they're helped, as they are, by some central banks who inject liquidity, like the European Central Bank, like the Bank of Japan, and like the Bank of China. So, at Novastone Capital, we have been meeting since last summer on a quarterly basis, and also when we saw some turmoil on the markets, we would come and meet quickly to discuss what to do in terms of the investment portfolios. So, we've had this global picture which was favorable, as it is now, for equity markets, but we've been cautious in terms of investing in equities. The main reason being volatility and, more importantly, valuation, which back in last summer we thought was a bit stretched, was a bit extended. So we were cautious and underweight in equities, and we were overweight in cash and absolute return strategies, unconstrained strategies, i.e. hedge funds. And this bet has served well because the returns have been good so far. Clearly, this fact that being overweight cash and underweight risky assets has helped us during the turmoil of last September, and especially this year, at the beginning of this year. So going forward, we now have a different picture. The global macroeconomic picture remains favorable, and valuations have come down a bit due to these corrections. So we continue now to build our positions, especially on the Eurozone and on the Japanese equity markets. We remain cautious on the emerging markets. We remain cautious on bonds and credit and high yield, but we are clearly looking for entry points in this asset class, especially the high yield bucket. And we are gradually increasing, taking opportunity of this volatility to build our investments in the risky assets. But all in all, we're really pleased about the returns so far. We've been outperforming the benchmarks, both in the invested portfolios, in the investment bucket of the portfolio, in the equity allocation, and also all in all, taking into account the fact that being overweight cash, which clearly helps when you have severe corrections like the ones we had in September and beginning of this year. So thank you for your attention, and see you at the next Investment Advisory Board.